And the rest of the country scratched their heads trying to figure out how we got into this mess, we decided to go to Frank Partnoy, a law professor at the University of San Diego who's written a couple of books on the subject.
Can you explain to me what a derivative is?
Yes, a derivative is a financial instrument whose value is based on something else. It's basically a side bet.
Think of it for a moment, football game. Every week the New York Giants take the field with hopes of getting back to the Super Bowl. If they do, they'll get more money and glory for the team and its owners. They have a direct investment in the game. But the people in the stands may also have a financial stake in the outcome in the form of a bet with a friend or a bookie.
We could call that a derivative. It's a side bet. We don't own the teams, but we have a bet based on the outcome. And that a lot of derivatives are bets based on the outcome of games of a sort. Not football games, but games in the markets.
Whether interest rates are going to go up or down?
Yes, and the new bet that arose over the last several years is a bet based on whether people will default on their mortgages.
And that was the bet that blew up Wall Street. The TNT was the collapse of the housing market and the failure of complicated mortgage securities that the big investment houses created and sold around the world. But the rocket fuel was the trillions of dollars in side bets on those mortgage securities called credit default swaps. They were essentially private insurance contracts that paid off if the investment went bad. But you didn't have to actually own the investment to collect on the insurance.